illustrious past chairman of Vijayawada branch, who made the branch vibrant, and all the professional colleagues, the viewers of this presentation. As we all know, yesterday the budget was presented. I have gone through some of the provisions and majority items relating to our profession I would like to cover in my 2 hours presentation today. To the extent possible, with my limited understanding, I will try to explain the effect of these amendments. Before going to the amendments, both in the direct tax and indirect tax, if you see the scenario as the Honorable Finance Minister has started the first sentence itself, that under peculiar circumstances this budget is being prepared, we must understand 3 important things. Number 1, the last 1 year COVID has resulted into, with the revised estimates, a 9.5% fiscal deficit. So for the 2021 financial year, the government expenditure is more than its receipts, both revenue receipts and capital receipts. So the fiscal deficit is 9.5%, and for the coming year also, though macroeconomic indicators have shown some buoyancy, some coming back, revival of the economy, in spite of it, to keep the momentum, to have an expected growth in the GDP. So without growth in the GDP, which shrank throughout the world, the economy cannot pick up. The employment of the people, the income earning capacity of the people, the per capita income of people will come down. So to increase the per capita income, to increase the growth in the GDP, the government has presented this budget with again 6.8% fiscal deficit for the coming year. So what this means, the fiscal deficit means the government is releasing more currency, more money into the society without real value addition. Thereby, by 31st March 22, we will have good amount of inflation. The average cost of living will definitely go up. So the fiscal deficit definitely will lead to inflation. But in spite of this inflation, the decrease in the value of the rupee, which is necessary, the government has taken the view from 2 other angles. Number 1, to raise this money, unless the government incurs more expenditure, it cannot achieve its goal. So to incur more payments, not necessarily expenditure, more payments, especially the government, this budget has focused on infrastructure. Infrastructure includes power sector, reforms in the power sector, road transport, railway transport, special goods corridors, eastern corridor, western corridor, airlines, some incentive is given. So the infrastructure, ports development, 5 ports are selected. So the infrastructure investment definitely is going to give more impetus to the economy. To incur this increased capital expenditure, around 5.50 lakh crores, which is higher by 34% when compared to last year, the government has to raise the money. One of the methods chosen by the government, as in the early years, is disinvestment in public sector units. Though this year budget also, year after year, they have been introducing, pumping in fresh capital into the public sector banks. Earlier 10,000 crores, now 20,000 crores for public sector banks. So two public sector banks are going to be privatized. One nationalized insurance company among the four general insurance companies like United India, Oriental, like that. One insurance company is going to be privatized, and then the selling of the shares, that is Air India, BPCL, IDBI like things are going to be sold in the open market. In fact, to do all these things, some of the amendments are also brought. Insurance Act is 1956 is being amended. So the government is trying to raise more money, not only through revenue sources, but also through capital sources. In fact, the capital receipts expected in the coming budget are around 41%. Out of that, 36% is borrowing. Only the disbursement, etc., will come to 5%. So, out of the 36% of the total budget borrowings on the receipt side, on the payment side, 20% will go towards the interest of earlier borrowings. So, as we all know, roughly 2 decades back, the FRBM Act, Fiscal Reforms and Budgetary Management Act, has come. But as per this, both the state government budget should not have more than 3% fiscal deficit. Central government also should shrink it. Now, due to COVID, relaxations are given in the FRBM Act, and the 3% has been raised to 4%, and with the 0.5% extra relaxation with the condition that the money shall be used for infrastructure. State governments have been given some power to borrow more money, and even the central government has shifted the compliance of the FRBM Act to 23-24 year. So the fiscal deficit, instead of controlling, has gone beyond the FRBM Act also. For that also, relaxation is sought by the government. So we shall hope that though many adverse imaginations were there through the budget, like there will be a COVID cess, there will be a revival of the estate duty, there will be removal of HUF from the tax entity, like this, several imaginations circulated through several media, social media, but dispelling all these misconceptions, our Honorable Finance Minister, has presented the budget without any new tax except the agricultural infrastructure development cess. That cess is not on the income tax assessed, but on the imports, especially some excisable goods, manufactured goods on the imports by way of customs duty, still customs duty act, and then the excise duty to certain manufacturing items like petrol, say, is applicable. So for them, reducing the import duty, customs duty, the adjustment is made with this agricultural infrastructure development cess of 5%. So the adjustment definitely will create a 1 lakh crores fund for development of agriculture. So that's only because in the last 1 year, as we have seen, around 23% shrinkage in the GDP, the sector-wise GDP, because as we all know, broadly we see the total GDP in the country. The old traditional sector is agriculture, then manufacturing, then service sector. So the manufacturing service sectors have shrunk, whereas the only sector which has shown growth even in this pandemic year, the 3% growth, is the agriculture sector. So the agriculture sector, unless it's taken care of, the growth in the economy and in the coming future years, it is very difficult. So the agriculture sector is being augmented with this. But a question mark may come. Earlier, education cess was there. Has the government used the education cess only for education purpose? Though in the Indian constitution it is there, in addition to the taxes that are being collected and shared to the state governments, some portion of the collection of taxes, the cess need not be shared to the state governments. That's why state governments are against the cess to be imposed by the central government. But the cess being collected shall be used for specific purpose. That was not the case in the earlier years. So maybe this agriculture cess is going to be used because the government said, as the Honorable Finance Minister said, for around 21 products, not only the wheat, maize, paddy, like that, for fruits also. So some of them minimum support price has been announced, including the millets. So this minimum support price, MSP, will definitely increase the agriculture sector. But one thing we should be happy that in this budget, no new tax is levied and no trust is given for giving new schemes to appease, to satisfy the downtrodden. If you go on giving subsidy schemes, that subsidy will not ultimately result into the growth of production. So this budget, no new subsidy scheme, no question of encouraging such practices. This, if all the state governments also try to emulate that, merely giving subsidies to the poor only to appease them and to ultimately to save their vote bank, maybe it may satisfy them, but not real economy growth. The economy to grow, which will ultimately give the dividends to each and everyone. So the economic growth depends upon more infrastructure, more spending by the government for production-oriented activities. So the budget, in one way, we have to appreciate the finance minister has done her best by not touching the individual slabs. So the first thing, the finance minister has not touched the individual slab rates, or not for that matter the companies, the cooperative societies, the partner firms. Nothing, no slab rates or say no tax rates are being tinkered. What are existing since last year budget, either for advance tax in the current 2021-22 or for assessment year 21-22, that is a running assessment year, no tax rates are tinkered. So just like the option given to individuals and HEFs to go for the section 115 BSE new tax, that is the lower rate of tax, foregoing right from HRA, standard action salary, or say the depreciation loss, carry forward losses, or say the section 80C deductions, like that. So either you opt for savings and the old rate, or without savings, without other house property loss setups, go for the new rates. That unchanged and continued, though many expected the lower slab rate of 2.50 lakhs will be increased, because to continue the status of having around 6.5 crore income tax filers, which compared to 2019-20 financial year, 2021 financial year has shown some growth even in the returns filing. So the returns filing, they want to continue. They want many people to come into the bracket. But mainly the thrust given by the finance minister, as I have seen, is rationalizing, using the digital technology to a more extent. Because just 1 month back, you have seen, just like on August 13th of 2020, on August 13th of 2020, the Honorable Prime Minister announced faceless assessment and a faceless appeal scheme under the Income Tax Act. So the faceless assessment and faceless appeal scheme definitely is more advantageous to the honest taxpayers. So the merit is going to be appreciated. So the Prime Minister having announced it and implemented it 1 month back, again, faceless penalty scheme has come into work. In continuation of that, in this budget, we are going to see in the coming few minutes, 4 more rationalization measures are taken that we are going to see as the important thing. The mind of the policy of the central government is that ease of doing business, ease of paying the taxes. If you have a genuine difficulty, definitely it has to be addressed. So that is the approach of the government, which we have to appreciate, because only by encouraging the honest taxpayers to pay more, and if at all they have a difficulty, genuine difficulty, it shall be addressed by the central government. So in that direction, many measures are taken. So without changing the rates of tax, even for a cooperative society, the option of 22% tax rate is continuing. And now I will go to the section 10. My presentation, I will take as we understand the Income Tax Act right from the student days, section 10 exemptions, then charitable trust 11, 12, 13, then the heads of income, then the deductions, then the assessment procedures, then other procedures. So like the appellate procedures. So like that, in the same sequence, I will take you through so that we can understand it better. Now coming to section 10, last year itself, due to COVID, people could not utilize their 2018-21 4 years block period. They could not utilize the leave travel concession. So it is expiring. So the government has announced that instead of traveling and then producing the actual expenses and then claiming the LTC, which is eligible for exemption under section 10(5), the cash can be taken as allowance, provided that cash is used for buying the goods, the white goods, or buying the services, which are like for a minimum GST at the rate of 12%. And the payment shall be, for payment of such a purchase of such goods or services, payment shall be made through bank only. If satisfy the other condition also, per person, for family they may give, per person, such expenditure shall not exceed 36,000 rupees. And such expenditure should have been incurred in between October 12th, 2020 to 31st March 21. So by next month end, this concession of LTC being received as cash allowance and claiming exemption, one-time benefit is being given by amending section 10(5). Then the 10 for NRIs, non-residents, 10(4)D, 10(4)E, 10(4)F are being amended. These are all nothing but offshore banking units, investment income in India is being exempted. That is 10(4)D. 10(4)E non-residents whose income from say IFSC is there. So the exemption is similarly 4F for non-residents on account of a leasing of aircraft and its parts. Say for example, aircraft engines are being given on rent. So if it is form part of that, then its income being given as a exemption, thereby the foreign inflow. This budget mainly has given, for example, in the insurance sector, hitherto the cap of investment is 49% of the capital. Now it is raised to 74%. So the government has given more foreign inflow of funds, thereby those foreign funds will improve the infrastructure in it, will improve the capital expenditure in India. So as part of that, these amendments are brought in section 10. And then we'll go to 10(10)D, one of the important amendments. That is, as we all know, maybe before 2009, any insurance policy, if it matures, you pay the premiums and you receive the bonus also on that because you are surviving. No death has taken place. Then the person who receives the insurance policy with bonus, the extra bonus is income exempt under section 1010D. In the past 13 years, they have amended saying that the premiums, people are higher premiums are they are paying. So they are expecting the bonus to be exempt. So before 2012, the premium was restricted to 20%, and after 1412, the premium is now restricted to 10% of the sum assured. If your premiums in 1 year payment are not more than 10% of your sum assured, then alone the bonus is totally exempt. Otherwise, the bonus is taxable. So, few years back, they have introduced the TDS from the LIC payments also. In case the 1010D total exemption is not going to be there, then they make the TDS. So once the TDS is there, the income has to, under which head income has to be offered. Naturally, it is a capital payment and you are receiving something. Now, as a more clarity this year, 1010D, any new policy taken from yesterday, 1/2/21, if it is a unit linked insurance plan, ULI, any premium paid per annum more than 2.5 lakhs rupees is not eligible for 1010D. That means higher premiums if you pay under the unit linked insurance, because nowadays most of the SBI Life, for example, you take, or many other things by one name. So they are all offering now insurance policies which are not merely risk coverage, savings come risk coverage. So people try to pay 5 lakhs, 10 lakhs, 20 lakhs. So then at the end they receive something. So now it is if it is a unit linked insurance policy, the government wants only the insurance, not that capital gains. So the insurer will invest the money in the units, and those units are redeemed when the policy is matured, and by a particular calculation, principal plus extra money is being given. That is now covered by the amendment this year. So from yesterday onwards, if any new policy is being taken, which is unit linked insurance plan, the below 2.5 lakhs per annum definitely is eligible for exemption. Otherwise, say it is just like capital gains. Is it equity oriented? Will go at par with section 112A. If it is other than equity oriented one funds, there is a debt funds. So that 112A benefit will not be there. The other long-term capital gains, including section 111A, will apply. So that's how the definition of capital under section 214 and the capital gains calculation 45(1)(b) are amended simultaneously along with the section 1010D. So this is applicable from the 21-22 assessment year itself, because these 2 months is covered, February and March. This amendment will cover from 21-22 assessment. The next section 1011, 1012, the Provident Fund, the Employees Welfare funds income is exempt from section 1025. But the money drawn from the fund by the employee, subject to its terms and conditions, either during the employment or at the time of retirement of the employment. So 1011, Provident Fund Act, 1012, Recognized Provident Fund. Here also, similar to this 1010D, if an employee contributes more than 2.5 lakhs per annum, because the Public Provident Fund, just like you and me, a non-employees or even employees also can go public provident, either in a bank or in a post office. Only at one place you should have a PPF. PPF interest without limit is exempt under 1015. So they have not touched it because the PPF maximum investment permitted under PPF per a person is 1.5 lakhs. So they didn't touch the PPF. But now coming to the ordinary PF Act 1925, and then the recognized provident fund, all private companies, private employers can constitute a trust and then go to the Commissioner of Income Tax for granting the recognition. So this is also restricted. Employee, if they contribute to 2.5 lakhs per annum only, their interest is exempt. Otherwise, say the excess if they contribute, the interest on a particular method going to be framed and announced, the interest is going to be taxable. The exemption is restricted. So this is also, say, as a tax planning, many people contribute more in the last 2 years of their retirement. Anyhow, after 2 years of their retirement, say, they will get the total money what they contribute. If you want savings, ATC, 1,50,000, you must keep the money 5 years untouched without even obtaining a loan for 5 years in the bank. So like that lock-in period, if you go to PPF, 15 years, subject to from 6th year, 40% withdrawal. So this PF in the last few years before the retirement, people offer more generally. Normal high income people also, employees, government employees continue. So they have restricted. This is the amendment. So coming to the other things, for non-residents, again, two sections are being brought in. 1023 of the capital gain to non-residents on a resultant fund, and similarly zero coupon bonds issued under section 1047. So the zero coupon bond definition, the infrastructure debt fund section 248 is also amended along with this. So issued by the zero coupon bonds issued by either infrastructure capital company, infrastructure capital fund, or a public sector company, or a scheduled bank. If they issue zero coupon bonds, as we all know, zero coupon bond by definition is I should say after 5 years I will pay you 100 rupees. Now I am issuing at say 75 rupees. So you pay me now 75 rupees. After 5 years I will give you 100 rupees. So this is in between, no interest is paid. So this zero coupon bonds income, if they relate to infrastructure debt fund, which is defined there, approved by the government, definitely is going to be exempt under section 1047. Similarly, the 1050 is also amended, which I will touch in a later part. Now, after section 10, I am coming to charitable trust. So the charitable trust, they have two legs. One 1023C, the other leg is section 11 exemption. Now 1023C is amended in this budget yesterday. The 1023C is small institutions, trusts, which are dedicated either for education, wholly for education, or for wholly medical relief, that is schools and hospitals, which are serving the public. Every street corner school, let us say, if their gross receipts exceed 1 crore, under 1023 small 3 AD, they have to obtain under 1023 6A or under section 12 AA. From April 1st, the 12 AA is going to be replaced by 12 AB. So a registration, a recognition from the Commissioner of Income Tax exemptions, then only, because their gross receipts exceeded 1 crore. Now to remove the difficulty, the government has raised this 1 crore limit to 5 crores. This applies to similar non-profit motive medical relief organizing institutions, trusts or institutions. So this is a 1023C amendment. This is applicable from 22-23 assessment year. Next amendment for this charitable institutions is in the case of charitable or religious institutions, in the case of section 11 exemption. Because as we all know, the computation of income, the framing of the written form ITR 7 itself is based on several court judgments. So now some clarity is brought by this year amendment of section 11.1, the explanations. So the new explanations try to clear the confusion or say dichotomy, because of a Supreme Court decision, the earlier years excess expenditure without any loss carry forward set of sections of 70, 71, 72, the case of public charitable trust, early years excess expenditure can be set off in the subsequent years, which has been approved by several high courts and also the Supreme Court. So to remove the difficulty, to remove this, they said charitable institution means no question of excess expenditure of early year can be set off. This amendment they have brought. Secondly, the capital expenditure only out of revenue income if you incur, it is an application. Out of capital receipts, that is corpus fund donations, or out of loans, if you incur the capital expenditure, it shall not be treated as application. This clarity has been brought in. So the further clarification is, if you receive some income, you keep in 11.5 more, though it is a capital receipt like income, then only in the year you withdraw from the 11.5 mode investment and incur the capital expenditure, then it will be treated as capital expenditure. So this clarity has been brought in section 11. This is about the charitable institutions. Now I'm going to the business head. In the business head, lot of tax planning has been done through goodwill. If a partner retires, the extra money he is taking is debited to goodwill account. Once you debit to goodwill account, then claim the depreciation on the goodwill, because the definition section 211B, section 2 clause 11, the block assets includes A, 211A, normal physical assets, 211B, the intangible assets like patents, trademarks, etc., including goodwill. So the Supreme Court decision in the case of Smith Security Limited 348 302, the Supreme Court has said that goodwill is eligible for depreciation. So to annul the Supreme Court decision, the now section 32 is amended, saying that in the case of goodwill, no question of depreciation. So similarly, the corresponding 45.4 in the capital gain section is there, that partners at the time of retirement, if they take extra money, number of dations, it is a capital receipts in the hands of the partner, not liable for tax was there. So now it is amended. When I go to capital gains, I will try to explain a mirror image of this goodwill in some other way they have amended. What they have amended, I will try to put before. Now 43B. So there is a lot of controversy. The Kerala and Gujarat High Courts gave in favor of the department that two components are there in the case of Provident Fund, employees welfare funds. The respective acts give monthly a due date. The employer collects employees from employees' salary some portion. Adding employer's portion also, he deposits. If there is a delay under 43B, this is covered, and till the due date under section 139(1), this can be paid. So the total money, both employer's portion, employees' portion, both if they are paid even under 139(1) due date after the close of the year, they are allowable as per 43B. Was the decisions assessee favor given by the Delhi High Court, Karnataka High Court, some other high courts. For example, Delhi High Court, AIMIL in 321 ITR 508, Delhi High Court has given, and in the case of CET versus Spectrum Consultants India Private Limited 227 tax man 64, Karnataka High Court has given assessee favor, whereas Kerala and Gujarat High Courts had given different decisions. So in your tax audit report, if your jurisdictional high court or a favorable high court decision quoting, people are still both for employees' contribution and employers' contribution, delayed payments are being taken as allowed, citing the decision in the tax audit reports also. So the amendment now made clear that the employer's portion is covered by, as defined in 224 definition, income definition section 224(10) and section 36(1)(5)(a). So the employees portion is not covered under 43B unless it is paid within the due date as specified in the respective act. It will not be allowed. Employer's portion can be claimed. So this is the amendment. So the decisions are set at rest. So this is the clarity that is brought. Now coming to the real estate sector, some small, it was earlier announced and now brought on the statute that we all know in 2003, by bringing in section 50C, any immovable property, if it is transferred for a price lesser than the guideline value, that is the SRO value, sub-registrar value, then 50C will get attracted. There are other decisions. For example, a Madras High Court saying that as per section 55, even 15% difference can be tolerated, no problem. So before it was a 5% and then 10%, and now this year budget, only in the case of 43CA, a businessman, a builder, if he is selling a residential unit and the difference between the actual consideration and the SRO. So actual consideration is the base price. So the SRO value is earlier 10%, now they made it 20%. So up to 20% difference, if the builder is going to sell, then in the builder's hand, the 43CA will not get attracted. Similar amendment in the hands of the buyer also, 56-10. So 56-10 is the other source of income. So the sellers of a property, capital asset is covered under 50C. Current asset is covered under business head 43CA. The residential property only is now covered, not the other immovable properties. The threshold 10% will remain for other properties, only for residential properties. This 43CA now amended. So the 10% and 20% are being given. Then last year, towards digitalization and the bank payments, the government said the tax audit limit of 1 crore is being enhanced to 5 crores. So if an assessee whose turnover is not more than 5 crores, if 95% or more sale proceeds are received through bank and his expenditure 95% or more is through bank, then he is eligible for this relaxation from tax audit. He need not go to the auditor. So no tax audit report is necessary. Maybe when we go to indirect taxes, we will see without these limits, GST 9 and 9C also being removed, section 35(5) of GST, CGST Act, that we will see later. So here this year, this 5 crores limit is enhanced to 10 crores. Say for example, a TV distributor, a fridge distributor, a refrigerator distributor, or any other products. Generally, it is not restricted to any product, but I am giving the example that generally, because they sell only through dealers to give the guarantee card or warranty period, so directly not be there. So for them, it may be possible that per annum their turnover is less than 1 crore, and they buy from the manufacturer only through payment of bank, and they sell to the people, and their expenditure will not be, other expenditure will not be more than 5%. Take salaries, rent, telephone, etc. They are from their turnover wise, from their gross receipts, they said. So this 95% or more through bank. So digitalization, they want to encourage. This will apply not necessarily for higher bracket, even a small person also, a cement dealer with 2 crores, 1 crore turnover also can opt this. So this small dealers also can opt, but for higher dealers, the limit of 44AB is. Then comes the professionals. As we all know, professionals as defined under section 44AA are eligible for, if their gross receipts are not exceeding 50 lakhs, they can go for 50% or more presumptive income taxation, just like 44AD through 44ADA. So for them, because the definition partnership firm includes LLP, they were also claiming the 44ADA. Now this year budget clarified for LLP partnership firms, limited liability partner. Most of the CA firms have, ordinary firms have become limited liability partner. For them, 44ADA is not eligible. That is the amendment effect. Then there is a income exemption computation mechanism in 44DB. There is a conversion of urban cooperatives, because in 2008 the Reserve Bank of India has given a guidance that urban cooperatives can become a cooperative banks, because the government's interest is not only the public sector banks or private banks, the NBFCs. Now in this year budget, NBFCs are also entitled to, if they are giving loans to infrastructure, they are eligible to get even foreign funds, NBFCs. So this year budget yesterday, in the Honorable Finance Minister has given the relaxation. So with this, the 44DB is amended in respect of the urban cooperative banks. Then comes the capital gains chapter. So in this capital gains chapter, the 45.4, there are a number of decisions that if a partner, for example, 5 partners contributing each 1 crore with 5 crores, they start a real estate business, they buy 5 acres land. So after 5 years, 6 years, 7 years, among the 5 partners, 1 partner is retiring. Instead of 1 crore his own capital, they might have developed the land, they might have done some business. So if he is receiving 3 crores, so what the partnership firm is going to do? It will revalue its original property value from the original 5 crores purchase cost. It will 3 times it will enhance. It will revalue them 15 crores. Then each partner's capital account say that 1 crore will become 3 crores, let us say. 3 times they have revalued. Then this partner, retiring partner, will take the 3 crores. He says, number of decisions. It is a non-taxable income in the hands of the partner. Even after 56(2)(10), that is any person receiving from another person. Partner is different, firm is different. Without consideration. Here, retirement itself is the consideration. I'm foregoing my right. Whatever he receives is not liable for tax. So it has become a big tax planning tool for several people. So they said, no question of revaluation assets at the time of retirement are liable if they are distributed with the original cost. The capital gains has to be paid. So the 45.4 is amended. Similarly, 45.4a, a new section is introduced in this budget. The 45.4a, any excess money paid to the partner or under this capital is liable to tax. So this is a new section 45.4a is also introduced. So much tax planning has been watered down. Then go to 50B, the slump sale. As we all know, the slump sale, any undertaking, either the company as it is, or one of its undertakings, as a going concern, if they sell, then the sale is liable for capital gains as a unit, the slump sale. So I have not sold, I have only exchanged. I have relinquished my rights in that. So people, because of some decisions, so the Artex Manufacturing Company, 227 ITR 260, Supreme Court decision of 1997, normal word sale doesn't, of a business concern, doesn't include the exchange or relinquishment. Similarly, the 2006 Supreme Court decision, Dampur Sugar Mills, the 147 STC 57, the Dampur Sugar Mills, instead of transferring the unit as it is, they said the molasses arising out of the sugar unit shall be given as consideration. So the word slump sale as defined under section 242C, definition section 242C, has now undergone a change to include whatever the transfers that are mentioned in section 247. Section 247 is the definition of transfer in relation to any capital asset. So that 247 mutatis mutandis is now brought applicable to the 242C, the slump sale. So thereby these decisions, no one can have a tax planning through other than the modes of actual sale for cash, that is the exchange or relinquishment or something, all now covered by the slump sale, liable for capital gains. So then the section 54GB, these also very few cases a chartered accountant may face. That is the, if a startup company starting a technocrat or an entrepreneur, if he sells his residential house, invests in the startup limited company towards the shares, and the money invested within 1 year is used for purchasing the machinery, then under 54GB, the capital gains on the sale of residential house are exempt. So that 54GB is extended now up to 31st March 2022. So for the startups, the 2016 amendments giving impetus for the Make in India has now been extended from 31/3/21 to 31/3/22. So thereby the 54GB is amended. So similarly, the 56 to 10, as I told you, 43CA, a real estate businessman, if he sells a residential unit, maybe an independent unit or an apartment, flat, then instead of 10%, the 20% threshold limit is enlarged, I said, under 43CA. The mirror image is under the head other sources 56 to 10 for the recipient also. But please be reminded, the exemption, the relaxation period is specified here, and two conditions are specified. The period is in between 12/11/2020 to 36/21. That means the coming June 30th is the last date for this relaxation. So in this period only the transfer should have taken place, and for the builder, he should be the first purchaser. That means that our property should not have changed in 2%, 3% times. So from the builder directly for the first allotee only this relaxation is applicable. And thirdly, the value of such a flat shall not be more than 2 crores. So not a very costly apartments, this relaxation is given. For a medium and small, there is a less than 2 crores only. This 43CA coupled with 56 to 10 is made applicable. Now I am going to section 80 deductions. So in the 80 deduction for startups, a startup has commenced the business earlier. We have seen that last year also the amendment was there. It's 100% income out of the first 10 years. Any 3 consecutive years, if it opts that startup under 80 IAC, its income is totally exempt. Its turnover should be not more than 100 crores. So that date of 31/3/21 has been extended up to 31/3/22. So for the startups, as we have seen the capital gains exemption 54GB, now in 80 IAC also for startups, this date is extended by 1 year. Similarly, the affordable housing projects. Last year we have seen the affordable housing means whose cost is not more than 45 lakhs. The value as per the sub-registrar office value not more than 45 lakhs. So their startups projects, the real estate project is for affordable houses only if is constructing and selling. So then under 80 IBA, their income is exempt. So as 80 section 80 deduction. Now 2 consequential amendments are made this year. The period of approval for starting the project is extended from 31/3/21 to 31/3/22. 1 more year, the time exemption is given. Another exemption is the same section. If they construct the houses for renting, the government said yesterday in the budget, for migrant laborers, they have to live in a rented house. So if such houses are very affordable houses definitely will augment the need of the migrant laborers, the government thought. So the rental income also is now covered, not only the project selling, real estate selling of affordable houses, now renting of affordable house also is covered under 80 IBA. That is from the assessment year 22-23, these renting projects are now given exemption. So similarly, 80 EEA, that means any buyer of an affordable house, we are seeing that the interest paid on the loan availed for buying this affordable house, if it is the only house it is having, under 80 EEA, 1,50,000 rupees is given a deduction for interest. Normally, self-occupied house or let-out house, you will find the interest under the section 24. So the house property head is not there now, because from the other income he can claim 80 EEA as a section 80 deduction, 1,50,000 rupees. For that, the loan availment period from 31/3/21, it's now extended up to 31/3/22. So there is a, now here onwards we will see the procedural amendment. So several procedural amendments are brought. Some of the procedural amendments, the first one I got immediately after the Honorable Finance Minister's completion of the speech, I got from several senior citizens, because I myself a senior citizen, from several senior citizens who are 75 years old. Sir, for 75 years, person's income tax return need not be filed, she said. What is that? Are we absolved from income tax payment? The amendment is laudable, but inside you see the conditions for this. What are the conditions? Under 139(1), every person having above 2.5 lakhs income, basic income, must file the return. Now the relaxation this year budget is conditions, 3 conditions. A person who is above 75 years, whose income is only pension plus bank interest, nothing else, only pension, salary, bank interest, normally other sources. Only these 2 incomes, nature of income should be there. The first condition, a resident of India, and his pension, if he is receiving from a bank, it should be a specified bank. The central government is going to notify some banks. It should be a specified bank. The interest earned from such bank, and by chance if he is having in some other banks also, by a declaration, he should include the other bank's interest also. And the banker is now given a new TDS section 194P. So for the banker, if he deducts TDS, computing his pension plus bank interest, after giving exemption for bank interest to some extent as providing the other provisions, the remaining bank interest taxable also he must take into account and deduct the TDS under 194P, a new section, TDS section. Then taking the recipient's declaration as he is discharging his tax liability, they need not file the return of income under 139(1). So 75 years aged persons, if they are not having house property, normally a 75 years person will have some house property income or loss also. So now if they have it, come to file the return. So if they are not having house also, they are living in a rented house, then maybe. So like that, this is applicable from the assessment year 21-22. So the relaxation, procedural relaxation, that for senior citizens they need not file the return means the tax is discharged by way of TDS through the bank. So the banker himself is acting as is a say auditor or say the ITO. The role is played by the banker, so that's why specified banks. So they are going to notify the specified banks. Then comes the procedural amendments. The partners of tax audit, they can file the return till the due date of the audit for the firm. So if the firm files the return, that due date is applicable to the partners. Similarly, in case of 92E, specified domestic transactions, the transfer pricing provisions as they apply. So they also apply here. So the due dates of partnership firms as applicable to the firm to file the audit report, whether it is 31st October or 30th November. So the due dates accordingly for the partners to file the returns also are now specifically extended so that the interest portion, the filing of the return, that one can avoid. So if they file within the time, there are two sections which are in the last 2-3 years have got amended in such a way that speedy disposable, CD, speedy compliance. So 139.4, the belated return, that means few years back we have been seeing in 1 year, last 3 years returns up to 31st March 17. Anytime a person comes, last 3 years returns at a time being uploaded. So that was all restricted, saying that any belated return before the close of the assessment year one has to file. So now that is preponed, not before the close of the assessment year, 3 months before the end of the assessment year. That means your belated return also, whether 31st July or 31st October, now 31st December. So 3 months before the end of the assessment year, any belated return, if its due date is earlier. Similarly, revised return also on 39.5, the 3 months before the end of the assessment year. So from next March and the coming financial year, these amendments will take effect. That's why some of my friends are putting in the WhatsApp that here afterwards, the medium practicing chartered accountants are relying on the income tax work. Only 6 months, July 1st to till 30th June, no due date. So from July 1st to December 31st, if they work 6 months, the remaining 6 months they can relax. So because the total major work is going to be in those period due dates, so the returns, everything. So that's how even the scrutiny assessments will be in that period only. So that's how they said the preponing of these dates are given. Similarly, 142, one small one, the notice to file the return within the assessment year, the assessing officer has to give. Now because of computerization, the assessing officer is an invisible officer. So the scrutiny assessment itself is faceless. That's why they amended the word instead of assessing officer, any authority under the Income Tax Act. Now computer generated notices are going to come asking to file the return rather than the assessing officer. That is 142, one small. Similarly, 143, 1A, the summary assessment, the intimation time. Once you file the return, the summary assessment, otherwise known as earlier. So the 143, 1A, the time of 12 months is now reduced to 9 months. That is for the intimation. The 143.2, converting to scrutiny. Now from the end of the assessment year, if one files a return, 6 months period is there for the assessing officer, for the entire department to convert into scrutiny by issuing a 143.2 notice. That 6 months period is also now reduced to 3 months. So the returns for 2021, if you complete by March 21, so the amendment is going to say if by June 30th 21, if 143 notice is received, it is a scrutiny converted case. Otherwise say no 143 notice, no question of scrutiny conversion. 148 is there. That time limit also we are going to see in the next slide, few minutes. So the 148 is also reopening, income escape. Once assessment year is over, whether you filed the return or you have not filed the return. Under 148, a notice can be issued to assess it under 147. Within the time limit, that notice of 148 shall be as per 149. The procedures are there for income escape to get assessed from 147 to 153. So that period is also being reduced now. Now the scrutiny notice issuing 143 to notice, first notice. Then once the scrutiny starts under 142, the other information can be called for. So the procedures are being streamlined because of number of cases, number of litigations that say the procedural complaints are not followed by the department. Thereby in the appellate stage here. So the 148 notice itself is invalid. Like the number of decisions are there. So to bring clarity, they have been made amendments. Now in between, I will come back to the as the government is heavily proposing the public sector units sale of shares or say demerger into separate units. So in case of demerger, as we all know, even in the case of a small partnership firm, if a partner is retiring, to the extent of the share of the retiring partner, the earlier years losses carry forward or say the whether business loss or carry forward loss or depreciation loss, the firm is not eligible. In the case of a closely held private limited company, if some shares are being transferred during the previous year, so to the extent the shares are transferred from those periods where the loss incurred, if that percentage of shareholding is going to change, with the who are continuing, to that extent only loss carry forward will be there. If there is a change in the shareholding pattern, to that extent loss carry forward will not be there. So a similar difficulty will be there for public sector units as the government itself is going to have demerger like thing. The shareholding pattern will change. So to safeguard that, an amendment is brought in 722A. Now another difficulty the non-residents are facing. So in India, normally the employees at the time of retirement, they will get the total retirement benefits. Afterwards, only pension. But abroad, developed countries, let us say USA, if an employee retires, throughout his lifetime, he will get a pension wherever he is. If you work, say, 15 years, 18 years in America, come back at the age of 45. Your age is now 85. The remaining 40, when you reach the age of 65, from that day onwards, the pension starts. So from the age of 65, say, because you worked 25 to 45 years is there, you receive the pension now. So that is the scheme there. So at the time of retirement, if you invest, just like your senior citizen benefit scheme in the post office, the banks now, 15 lakhs is there. You will get higher rate of interest. So a senior citizen. So the retirement funds will be there in abroad. If those retirement funds give more returns, if a non-resident, when he was there in abroad, say he contributed for the retirement fund. Now after coming to India, becoming a resident, if he withdraws the money in the foreign country, if it suffers income tax, again second time in India, while calculating the income, because in India you can adopt a accrual system for the income of that foreign retirement fund, whereas foreign countries only at the time of payment on cash basis may levy the tax. So the mismatch will be there. So for the mismatch sake, the amendment is brought to give the relief to the non-residents who are withdrawing the funds from the foreign retirement funds through 89A, the amendment. So then we are having MAT 115JB. So in the MAT 115JB, in case applicable, as we all know, for limited companies, calculating the book profit to pay the 15% tax. So when the normal computation use loss or say negative income, zero income or negative income, simultaneously book profits under the Companies Act, if it is having profit on the book profits subject to some plus and minus given in 115JB, 15% tax has to be paid by every limited company. Now the amendment is, in case in the current year book profit, the adjustment is on account of earlier year's income, because based on the earlier year's income, either under 92CC, the advance pricing adjustment, or under 92CE, the secondary adjustment, right? As we all know, in transfer pricing, primary adjustment, secondary adjustment will be there. So in case the dividend income is there for that limited company, and as per double taxation avoidance agreements in the hands of a foreign company, which has invested in India, if it's going to be there. So in all such cases, because earlier year's income is coming as dividend. So in all such cases, the current year book profits shall not be subject to book profit 115 JB tax. So the 115 JB appropriate amendment is made to give the relief for these subjects. Now we go to the TDS provisions. The TDS provisions, as I told you, in the case of a 75 years senior citizen, the specified bank is made the TDS deductor. So instead of the bankers normally when they pay interest only, TDS provisions will come under 194A. Whereas now, in the case of a pensioner who receives his pension through the specified bank, including his bank interest, his tax liability has to be ascertained by the specified bank, and when once the specified banks deducts taking a declaration from the senior citizen, the 75 years completed senior citizen, under 194P, once they deduct the tax, the senior citizen need not pay the return. Now, a new TDS section is introduced, 194Q. Last year itself, we have seen the new TDS section saying TCS section. Last year we have seen the new TCS section 206C we have seen. So what is that last year new 206C? A seller of goods who is selling to a buyer, if the seller's turnover exceeds 10 crore per annum and the buyer is purchasing more than 50 lakhs, from 1/10/2020 last year budget has introduced a new TCS section. That means a distributor is selling to a retailer. Distributor's total turnover is 10 crores or more. The retailer's turnover is, retailer is purchasing from this distributor more than 50 lakhs per annum. Then 0.01% tax has to be deducted, 0.1%, 0.1% TDS has to be deducted. So not deducted. Last year amendment is 206C to be collected from the buyer. The seller has to collect. That was 206C last year amendment. Now this year amendment is, in addition to that, TDS is introduced, a mirror image. The buyer has to deduct the TDS when he is paying the money to the seller. Last year amendment is, the seller has to collect over and above the purchase price, that 0.1% from the buyer. Seller has to pay, collect the TCS amount, income tax amount, and then pay it as TCS. Whereas now, a new TDS section, who is the payer now? Buyer is the payer. So buyer is now casted with a liability under 194Q to deduct when the two conditions. The buyer whose turnover now exceeds 10 crore. Earlier TCS, seller's turnover 10 crores. Now the buyer's turnover exceeds 10 crores per annum. And the buyer is purchasing from that particular seller exceeding 50 lakhs. First 50 lakhs, no. When it exceeds 50 lakhs, he must, when he is paying to the seller, he must deduct 0.1%. Now you may ask me, is it not a duplication? Both the buyer is attracted seller. Now the saving clause is given in 194Q that in case it is covered by the other TDS, TCS sections, this section will not be there. Or in case this TDS section is complied, the other sections need not be complied. So the saving clause is there, duplication of TDS, TCS will not be there. So just like you would have seen the 194M, that was also the recent years introduced 194M. What is it? An individual HEF, if he is not a tax audit person, if he is not a tax audit person. If he enters into any contract for goods or services in 1 year for more than 50 lakhs, he must deduct TDS. So that 194M, who individuals, HUFs who are not covered by tax audit sections, if he is covered by tax audit section means 194C, contract payment, everything will apply. 194A will apply. That means a trader, a manufacturer, if he is once a tax audit person, all the TDS sections will apply to him. So for them, that 194M will not apply. If he is not a tax audit person, that 194M, because he is paying, he is entering into contract, he must deduct the TDS. Similarly, here, there also the saving section. If he is covered by some other section, so either TDS or TCS for one transaction, one time only, not second time duplication. That is the sum and substance. One should go through carefully these provisions meticulously, then only you can avoid this duplication of either TDS or TCS. Now, the 194 dividends. So earlier limited company dividends, because of lack of technology, instead of collecting from the shareholders, millions of shareholders, company only when it is paying dividend distribution tax was there. That was removed in the last few years, as you all know, that dividends now companies pay with TDS, but dividends are taxable in the hands of recipient, the shareholder. Now, there are real estate investment trusts and business trusts. So they are all pass-through status is given. That means to encourage more transparent after the 2016 Real Estate Regulation and Development Act, the government brought in these business trusts, real estate trusts to encourage more transparent real estate activity. So, so that more foreign funds will flow in. So in case of these trusts, they invest in the infrastructure companies. So they receive the dividends and again pay from the same income to the shareholders. So the 194 relaxation is now amended and given a pass-through status for these trust dividends income is given. Similarly, 196D in the case of foreign institutional investors, especially from income from securities. So the rate at which the TDS has to be made, the relaxation is given. So subject to section 115 AD, the withholding tax where 20% is there, because NRI's income 20% at the rate of 20% is taxable, but subject to the double taxation avoidance agreement. So with from 1421, subject to section 90 or 90A, wherein the double tax, if Indian government is having a treaty with another country, the treaty TDS rate, the treaty tax rate will supersede the Income Tax Act rate. As we all know, in some TDS sections, the Act itself gives the rate. For some TDS sections, the Finance Act will give the rate. So these two will get superseded once the rate is mentioned in a double taxation avoidance agreement. So the maximum limit is subject to double taxation avoidance agreement. The due amendment is made in 196D, especially these are foreign institutions. Then two new sections are introduced, which are earlier, as we know, for TDS, if the PAN number of the deductee is not available, deductee has not furnished the PAN number. For example, in a compulsory acquisition, district collector is paying the compensation for land acquisition. The district collector will, the original compensation is not taxable, so he will pay the principal amount. For interest, he deducts the TDS. So the compensation receiving person giving his PAN number, then for the interest of 10%, he will deduct 20% because 206AA says whenever a TDS liability is there, the deductee has not given his PAN number, then deductor will deduct at 20%, 206AA. So now a rationalization for TDS and TCS is given. Not on account of that PAN number, a new section is introduced. As in last year, the amendment rationalization is whenever a TDS section or a TC section is applicable for a particular transaction, and the other person, though is having the PAN number, has not filed in the earlier 2 years his return of income, a return non-filers, their rate of TDS or TCS. For TDS, the new section is following 206AA, a new section 206AB is introduced. For TCS, earlier 206C, now 206C, 1H, subsection 1H. So the new TDS and TCS sections which are proposing that in case the recipient is not having the proof of filing for earlier 2 years the return of income, then higher of the three, twice the rate as applicable in the Act or twice the rate as it is in force. That means if not in the Act, Income Tax Act, through the Finance Act, a rate is prescribed for TDS, TCS, either that rate or 5% or 5%, because some of the TDS and TCS rates may be 0.1% to 1%, 2%. So if you say for 1% double means 2%, no, either double the rates or 5%, whichever is higher. So if earlier 2 years, so now the deductor's liability is increasing to examine whether deductee has filed in the earlier 2 years his return of income proof he has to obtain. And this condition is the deductee's TDS or TCS should be more than 50,000 rupees in each of these two preceding years. So his TDS TCS is more than 50,000 rupees and he has not filed in the earlier 2 years his return of income. Then in that case, the newly introduced two sections will increase the rate of TDS or TCS, which is higher, that is twice the rate or 5%, whichever is higher. So it is to ask the persons to comply that once he is having a TDS or TCS, they must file their return. Simply foregoing the TDS is not going to be matter because he is going to suffer higher rate in the subsequent years. So for non-filers of income tax return, it is one way forcing them to file the return in the subsequent years to get to avoid the higher rate of TDS in the subsequent years. So the dividends have now become the taxable income. So as the dividends have become the taxable income, normally the companies declare the dividends. For example, interim dividend, it will be declared January to March. 9 months income they will see. During the financial year itself, they will declare the interim dividend in the latter part of the year. Similarly, for example, 2021 financial year, the AGM will be in September 21. The AGM declares dividend in September 21, and then they will pay the dividend in October 21. So now the advance tax liability 4 installments, June 21, June 15th, September 15th. So for all the defaults, the interest is being calculated now. So to avoid this anomaly, because it is not in his hands to estimate the dividend of the limited company, the recipient shareholder cannot estimate the dividend and pay the advance tax sufficiently. So to remove this difficulty, 234C is now amended. The 234C interest for shortfall in advance tax, shortfall just like our capital gains, just like the winnings from lotteries. So the capital gains and winnings from lotteries are only from the day the capital gains arise, the interest is calculated for advance tax under 234C. Now limited company dividends are also brought within the same purview at par with them, that in case the dividends are declared or paid, actually the section 8 in the Income Tax Act deals with the income of dividends, which says Section 8. Either they paid in they will become the income in the year in which they are declared or paid, whichever is earlier. So at par with that, now the 234C is amended. So this is about the interest calculation for advance tax. Now the other rationalization provisions, see, the income tax appeals. With the assessment you are not satisfied, you will go in the appeal before the income tax commissioner. The income tax appeals sometimes will take 2 years, sometimes take 4 years, 5 years also. It's my individual experience also. So instead of that, the assessee suffers. Finally, the Commissioner of Income Tax Appeals is confirming the assessment order. Then the interest on the taxes. Then follows the penalties. Once the first appeal is completed, the penalties. So the difficulties of the assessees are more, especially small assessees. So to address this problem, a new section 245 MA, what they said is dispute resolution committee. So the dispute resolution committee, if the assessee wants, instead of the prescribed first appeal, second appeal, appellate procedure, he can go to this at his option to the dispute resolution committee at the option of the assessee. Two conditions are to be satisfied. So the two conditions are, his return of income should be less than 50 lakhs. The addition made to the return of income during the course of assessment. Now you all know the faceless assessment scheme has come. So no question of same town, same city, same assessing officer, and then face to face. So the faces are being removed and made faceless, the assessments. So in spite of that faceless assessment, still some addition is made. If such addition is less than 10 lakhs, so return of income below 50 lakhs, small assessment. Addition is not more than 10 lakhs. And third condition, it is not a search case under 132 or survey case under 133A or a foreign income case where a relief is claimed under 90 and 90A adjustment. So if it is not like that, then they can opt to go before the dispute resolution committee thereby. So how much is the real income, how much tax and interest you can collect. Thereby, they can grant immunity from prosecution and penalty. Now, as on this day, this immunity from prosecution and penalty only with the settlement commission is there, 245C. From yesterday, the settlement commission is abolished under the Income Tax Act. So they made two parts. Settlement commission is the only authority under. We are having for Southern India in Chennai the settlement commission. Normally the Chennai settlement commission, the search cases, survey cases, high income, concealed income, reopened cases, generally they go before the settlement commission, more than 50 lakhs tax payment. So they're all go before the settlement commission. Thereby they can get immunity from penalty and prosecution. So instead of that high income group going to the settlement commission, the present government, even for small assessees, to avoid repetitive appeals, suffocating appeals, not only for the quantum addition under the assessment, but penalties also, to avoid what they have said, the under 245 MA, a dispute resolution committee is being formed. Before that committee, a committee means normally not one officer, two or more. So the mechanism is given and being prescribed, going to be prescribed also. If you go before the dispute resolution committee and settle your matter, the DRC can grant immunity from penalty and prosecution. So these conditions only are to be satisfied. So for small assessees, it is better the litigation. In fact, it is very laudable. Only from the present government, I could see they don't want the litigation. They don't want to prolong. A genuine assessee, genuine difficulty, come on, give the relief, let him enjoy. He's a genuine person. Because of the interpretation of the words, because of the dichotomy in the Income Tax Act, the SSC is facing a difficulty. That difficulty shall be removed. A good approach. That's why we are having faceless scrutiny cases, scrutiny assessments, and faceless appeals. Now we are going to see the other simplifications also. So now the first for small SSCs, as there are big SSCs have gone in the past to the settlement commission and got the benefit, a benefit is being given by giving an option to the SSC. If he wants to go in appeal, if he still feels the merit is there and a debatable issue, okay, you go there. You don't want prolonged debate, discussion and litigation, go for settlement. So instead of using the word settlement, dispute resolution can be these things. So then the advance ruling. So the advance ruling authority, normally the NRIs, whether my transaction is liable, do you call it a royalty? Do you call it a technical fees? Do you call it rent? A rent sometimes is called as royalty. For example, a sale price is termed as technical fees. So some wording, some difficulty will be there. So the advance ruling authorities, for example, a particular agreement, 2-3 companies jointly will promote a metro project. These 2-3 companies, 2 foreign companies joining with the third Indian company will bid and get a new metro project, railway project. One is engine supplying, another one is track laying, third one is managing the signal system and managing the trains. So these 3 companies, is it a joint venture to be assessed as AOP or is it individually to be assessed? The advance ruling authority. I gave a live example. So like that, the advance ruling authority is there in the Income Tax Act. So that is now being replaced because they could not find much benefit. Now they are going to be replaced by a board for advance ruling. The new sections are there. In case they are aggrieved by the board for advance ruling decision, it is appealable to the High Court. Like that, they are now bringing in a rationalization. So through this rationalization, the advance rulings, because when the transaction is about to take place, during the previous year itself, it will go before this authority and you will be knowing for certain that what is the opinion of the department, so which is binding on the department and the SSC. So this is the rationalization. So AR is being replaced by BAR, that's the board for advance ruling. Similarly, 148 notices, number of difficulties in 148 notices, because the due to internal audit by the income tax department or due to the CAG audit, the cases are being reopened by the assessing officer, saying that some income escape. Though in the scrutiny case, the officer is looking into all these things because he has not put in writing in the assessment order elaborately that I have examined X, Y salaries, I have examined rent, I have examined. He will not write. Assessee has produced all the vouchers for expenditure and explained so I am adding this much only. Then some audit party will say, no, the auditor, the income tax officer who has completed this scrutiny has not looked into some other, there is a possibility of something. So the audit objection and imagination is resulting into, culminating into a reopening of section under 148 for reassessment of income escaped, deemed to have been escaped or concealed. So the 148, present 148 is now yesterday is proposed through the bill, a new 148 section. Similarly, a 148A, a new section is being introduced. Old 148 is being replaced, new 148 is being introduced, and the present 149, the time limit within which the 148 notice has to be given is being amended. These are all the proposals in the yesterday finance bill. So now we are discussing them, that Earlier 6 years can be reopened, the present status. And in case, in such cases, 132, if the income escaped is exceeding 50 lakhs rupees, up to 10 years, the reopening can take place, the present status. So now the bifurcation is made. In the ordinary cases, so earlier number of decisions, the assessing officer before issuing section 148 notice should believe that the income has escaped. The assessing officer would have given a reply to the CAG audit party. No, there is no escapement. But in spite of it, CAG audit party has given a para notice and then saying that income escaped. So then the assessing officer will serve a notice, I am reopening. Assessees have succeeded in the appeals saying that you have got a borrowed satisfaction. What is 148 says? The assessing officer should believe that income has escaped. You yourself reply to the audit party that no escapement, that means you are not satisfied. But because they have given their audit objection, now you are reopening. So then it is a borrowed satisfaction. No, 148 notice itself is illegal, invalid. Now this year amendment, all such things are valid. A final objection raised by the Controller and Auditor General is also valid for reopening, though it is a borrowed satisfaction. Now the Act made clear. So the words interpretation all these days, majority 148 notices in the appeals, somehow or other, 148 itself is invalid. Like that, people were arguing. So that argument is not tenable now, because in the amendments yesterday, the budget proposed is the CAG audit objection also can be there, but not more than 3 years. Similarly, any risk management flagging, that is any information flagged in the case of the SSC for the assessment year, that is in the sense that the computers were having specified financial transactions. In the 26 years you are now downloading now for 17-18 assessment year. In 2019, if you have downloaded the same 17-18 assessment year, something is not visible. Now it is visible for the same 17-18 year. A document more than 30 lakhs you have registered in December 2016. In January 2017, you purchased, you sold. Earlier, they were not visible. Now they are being made visible. You would have seen in November 2020 for financial year 19-20, for financial year 18-19, cash transactions, SFT1, SFT2, the specified financial transactions, 1, 2, 3, 4 are there. So the part E of the 26 years, where specified 14 types of specified financial transactions are there. If they throw in, if they flag something and it is missing in the original return, now it can be reopened. So now that reopening is also with the prior permission of the higher authority, principal commissioner. So the section 285BA, 3 years back it was a air information, air data, annual information return. Now it is a SFT return under 285BA. As per SFT return, which is throwing the data through 26 years to the assessing officer. The assessing officer, in case he feels that the income has escaped, he can go back and then earlier 3 assessment years only, not the 6 assessment years. So the government itself is reducing its reopening power from 6 years to 3 years by amending section 148 and then 149. Similarly, a new section 148 is also 8A is also being introduced. In the case of such cases, survey cases, say the reopening can go back up to 10 years, provided the income escape is 50 lakhs or more. So before issuing 148 also, an opportunity shall be given to the SSC. In my view, this particular transaction is not reflected in your return. If you have any objection, you tell me. Minimum 15 days, maximum 13 days time shall be given. So before issuing the final notice of under 148 itself, an opportunity shall be given to the SSC. This is the new amendment. So definitely a laudable thing. So more simplification, rationalization is being done by the government in the case of reopening of the assessment. I have seen a number of assessments, 3 times reopening, 4 times reopening, same assessment here, same SSC. First time reopen, second time for some other cause, third time for some other cause. Reopening. I have faced these things. So now this transparency, more accountability from the department side is given. So the other rationalization quickly as the time is running out. As I told you, 245C settlement commission is abolished from yesterday. All the pending settlement commission cases also are going to become an interim board. A new interim board for settlement is going to be constituted. So the IT also, similar to the settlement commission, the income tax appellate tribunal also now physical filing, and due to COVID, through virtual mode, the video conference mode we are attending. Maybe from yesterday, the Hyderabad tribunal also has given the option to go for physical hearing, either online mode or the physical hearing also is given. So now the government proposed, so this income tax appellate tribunal case also through a national dynamic mode, one can opt for a IT. So if he opts this dynamic mode, then instead of physically going and standing before the IT, through virtual mode also, one can have the matter settled through the IT. So this also a faceless in the sense online mode of IT proposal is being brought down. So last 1 or 2 items. So the provisional attachment, even in the case of fake invoices, can be made. 281B, the provisional attachment provisions being amended. Similarly, 165A, the equalization levy in the case of e-commerce operators, 2% earlier was there. So their income is exempt from section 1050. So that is also being rationalized. So with this, I have completed my direct tax presentation, and on indirect taxes, few items I would like to present. So especially in the GST, some few important amendments let us have in the coming 5 to 10 minutes, and then we will try to complete the discussion. So especially, as I told you, in the import duties, because of the new agricultural infrastructure development cess, they said, the government has said, this is not an additional burden for the consumers, because they are reducing the customs, accordingly adjusting the custom duty rates and excise duty for certain manufacturing, including the cotton, petrol, gold. So the agricultural infrastructure development cess is one new development. And similarly, we are going to have the GST input tax credit will be given only based on the supplier's GSTR1. So the supplier who sold to you, unless he uploads his data through GSTR1, monthly GSTR1, the purchaser cannot take the credit for the input tax. So that is now amended. And we have seen the famous Calcutta Club decision, principle of mutuality. Under the Income Tax Act, still your social clubs or any other, say, consumers cooperative stores or apartment resident dwellers, association. So all these things, in majority of the cases we are having the principle of mutuality. Those associations are not liable for income tax. So still under the Income Tax Act, the principle of mutuality is being appreciated. But under the GST, because of CGST Act Schedule 2, Clause 7, the transactions in between the association and the members, are they two separate persons or single person? The Calcutta Club decision said they are one and the same, no question of supply being taking place. So between two distinct persons, supply can take place. Of course, between one person itself, for example, the head office, branch office transfers, interstate 2 branches are there transfers. There are supplies now, deemed supplies, even from right hand to left hand, from within the same person. But now the Calcutta High Court decision said it is not a supply. So with retrospect from 1/7/2017, to keep aside the decision, the amendment is made in the GST Act that it is a supply, it is liable for tax, GST. Similarly, GST audit, as mentioned in section 35.5, we have seen the portal difficulty and also the audit is difficulty because 2017-18 GST annual return and the audit report 7 times the time has been extended. So the difficulty shall not occur hereafter. So they have amended the section. They proposed the amendment, not amended. They proposed the amendment because we are all discussing throughout this day. Only the bill put before the Parliament. Once it passed and then assented by President of India, it becomes the act. So the GST audit and reconciliation under 9C is being removed in the sense the small tax practitioners in indirect tax, especially the chartered accountants, are going to suffer. So this has boosted the youngsters to come to practice. Hundreds of thousands of my professional colleagues, junior CS have jumped into the profession because of the GST. Now with the streamlining in the Income Tax Act and the simplification in the GST, if in the coming 2-3 years, if the GST is also becoming faceless assessment, faceless appeals, and then simply without audit self-declaration, the annual return has to be, the reconciliation has to be certified by the dealer only, and he has to upload finish. So the work will come down to the CS in this particular area. This situation is really bad news for the profession, but anyhow, we have to bear with the truth. So similarly, the setting of the electronic cash ledger balance for arrears, is it net on the net due to the government, one has to pay the interest on section 50, or on the gross? That dispute was there, several courts, this side, that side. Adverse decision from Hyderabad High Court we have seen, but anyhow, favorable decision from other courts. So now the Secretary tries saying that genuinely what the government money he used, that only on that portion only he must pay the interest, not otherwise. So similarly, the vehicles inspection and then their confiscation, then the penalties. So these are all the 73 confiscation section is there. So the tax and interest, how much he has to pay, or say in case of disputes, the conveyance section 129, 130 was there. So for that, instead of the goods value, the penalty either 200% or 100%, and if you dispute with the penalty, pay the 25% of the penalty and go in appeal. So these are all the amendments more favorable for the SSC simplification has been done. So the GSTR 1 is under section 7512. So that amendment is made now. Then to attach the property, earlier some decisions have come. So the not necessarily a pending demand for attachment, a pending initiation of proceeds. Just like your some 30 minutes back, we were saying 281B, the income tax attachment is when the survey starts on the first day itself, when the search takes place on non-income taxes, say search takes place. Primarily, they found that some concealed income, some tax liability. Then on that day itself, the attachment can be made a provisional attachment, pending the demand, pending the completion of assessment, pending the raising of the demand tax demand. So the attachment to the property. Property includes immovable property, even the movable bank account can be attached. So the provisional attachment, now the clarity is brought in the GST Act also, similar to the Income Tax Act under section 83, that the provisional attachment can be made from the day of initiation of the proceedings under the GST Act, not necessarily determining the tax and finality being reached. So these are all things. Other amendments also in the GST Act, the normal supplies to SEZs are at par with the exports. So for the exports and the SEZ supplies, the zero rate tax only on the specified transactions. So like this, the amendments in the indirect tax front also are being proposed. Definitely, number of tax rates, say for example, electronic goods are a little bit costly, they are going to be, because a enhancement in the rates. But anyhow, these are all, as I said in the beginning, make in India concept to encourage more entrepreneurs to start production in India, and the government taking the economy to 5 trillion economy in the near future, definitely, because the GDP growth of 11% in the coming 21-22 is definitely feasible. A double-digit growth of GDP is going to take the economy to new heights. Especially yesterday, you have seen around more than 2,000 points Sensex are increasing. So before the budget itself, around 400 points, before the presentation, before 11 o'clock itself, around 400, 500 points increase. And ultimately after the budget presentation, so they ended with more than 2,000 points of increase. So the people who are in this sector has seen the bright side of the growth of the economy. And I'm sure in spite of the inflation, if properly one plans to offset the inflation, the net wealth will grow. And I wish all the listeners to increase their wealth, not only in this knowledge wealth, but real wealth also, being a part of the financial sector. The proper planning, proper approach will definitely make all of us reap the benefits as the country progresses, as the country grows, country's economy grows. We can also grow and take part in it by, as the past president, the illustrious past president Abdul Kalam has said that CAs are partners in national building. We can, as partners in national building, can do it. So now it is up to the organizers to conclude. So this is how I am thankful to the organizers for giving this opportunity to share the thoughts on this budget, especially Srinivas Rao Garu, the chairman of the branch, and Siddharth Shireen, the secretary, and other committee members. I thank them for giving this opportunity of sharing my views. So within the given time, 6 to 8, I try to complete. I think some other things I might have omitted, but anyhow, it is up to the organizers to conclude. Yes, sir. Another thing, Srinivas garu, చెప్పండి. మ్యూట్ లో ఉంది, మీ వాయిస్ మ్యూట్ లో ఉంది శ్రీనివాస్ గారు. శ్రీనివాస్ గారు, మీ వాయిస్ వినడం.
Is it possible to take up some of the questions, or shall we this thing? Is there any paucity of time?
No,
I don't know about your appointments because
the budget questions means the finance minister has to answer. I presented their views only as I understood. So I am not that much level to answer on the budget. The questions means anyhow, if they are very possible, one or two you can.
Yes, sir. Thank you very much, sir. That is a wonderful and excellent presentation, because the market itself, as you said, that well taken the things. Yesterday it is 2000, and today also there is 1500 points are increased. So it is already crossed more than 50,000 mark once again. So definitely the markets and the business people are seeing the growth and brighter side of the subject, though there are not much rate concessions or something like that, but part A of the budget really gives moral boosting and greater scope for the employment and other things also. So if anyone is having any doubts or something like that, sir presented the budget, both GST and ST income tax, in an excellent manner. So there are, I think in chart there are one or two questions, sir. Regarding this, Mr. Satish Penugonda is asking, sir, if TCS is collected under section 206C 1H by the seller, then TDS under section 194Q by buyer is not required. Finance bill has stated a reverse situation. Please throw some light on the interpretation.
Yes, you are right. You are right. So either of these two sections only, this is only a bill. If a real difficulty is there, practically they will try to avoid the difficulty. So our past chairman sees Subride is son only he is, I know. So dynamic person, Subra Garu also is visible in front of me. I'm seeing Subra Garu also. So, so actually, my debate started with Subraidu's initiation. He has done, say, when he was the chairman, number of times, number of topics he used to ask me to take up. So, so what he said is a genuine difficulties clarification we will expect from the finance minister. Definitely only one of the things that is going to be applicable. Yes, sir.
Sir, I think Sriram Garu, is there any doubts from your side or something like that? You are visible in 2 videos. Voice లేదా మీరు అన్మ్యూట్ చేసుకోవాలా అన్మ్యూట్ you have to unmute yourself. Oh, I'm not giving the permission. Yeah, now I have given the permission. Everybody can unmute yourself.
Thank you very much. Actually, we have to make certain representations for clarity in the profession. Unless we make a reasonable and fair representation, we will not be able to practice in better than what we have today.
మీరు అదర్ డివైస్ లోంచి కూడా ఎంటర్ అయ్యారు. ఆ డివైస్ ని స్విచ్ ఆఫ్ చేసేయండి, లేకపోతే రీసౌండ్ ఈకో వస్తుంది. ఏదో ఒక డివైస్ లోంచి రండి సార్.
ఓకే,
లేదు ఈకో వస్తుంది. 2 డివైస్ లోంచి ఉన్నారు మీరు.
రీసౌండ్ వస్తుంది.
యా
ఫస్ట్ టైం జూమ్ మొదలెట్టింది. ఒకటే ఓపెన్ చేశాను
కానీ ఓపెన్ చేయొచ్చు, కాకపోతే 2 ఉండేసరికి ఇంటర్నెట్ క్లాష్ వస్తుంది సార్. ఆర్ శ్రీనివాస్ గారు, ask any question.
Hello, I think there is no sound.
శ్రీరామ్ గారు 2 మీరు షట్ డౌన్ చేసేసి ఏదో ఒక దాంట్లో ఎంటర్ అయిపోండి. స్విచ్ ఆఫ్ చేసేయండి సార్. శ్రీరామ్ ఉంది, రీడ్ దాంట్లో ఉంది.
I think now you can hear me, right?
Yeah, of course.
Now you can hear me without resounding.
Yeah.
Hello?
చెప్పండి, మీరు దేంట్లో ఉన్నారు ఇప్పుడు?
Can you hear me right now?
Yes sir, I can able to hear, but read me దాంట్లో ఉన్నారా? Okay.
Can you hear me right now?
Yeah. Please go ahead. Yeah.
Okay, thank you. See, budget has got some couple of retrospective amendments which BJP is against, but we have to see that the retrospective amendments are taken back. And further, we have to make a reasonable representation wherein we get some hardships in writing. Unless we represent, they will not rectify it. We have to make certain representations. That is my opinion.
If there are any representation, you can share it to the branch so that from branch side, we'll send it to the finance department.
I will write representation in a couple of days because after 10th, they may take up decisions very quickly. Before 10th, I will send you. Okay, in a couple of days.
There is a request from the institute side saying today only I got the mail from the ICAI saying that if there are anything that are to be conveyed, please convey the same before 5th.
One more thing.
We can
this right
and submit to the finance department. That
I have already put up some 2 representations before the finance minister, stating that the private and small companies and also the partnership firms should be treated as pass-through entities, so that no tax should be paid by the firms, partnership firms, or by small limited companies, such that only the individuals should have to pay. If that is brought in, we can take a major advantage in the profession. Particularly, small scale industry will have a large impact. Today, most of them are not joining together on account of high taxation at the level of double taxation for small firms. This double taxation should be done away with at the earliest. I think I can properly communicating because the world over partnership firms are not taxed. So also small companies were not being taxed. They are treated as pass-through entities. So in that case, smaller companies are hardly hit. That means the double taxation is prevalent. That should be done away with. Hope I communicated. Thank you.
Yes, sir, I understand. Thank you very much. Sir, inka evarana ante this point is self-explanatory. You would like to...
Agree, sir, Falguni Kumar garu?
Bond.
Can I have your opinion on this matter?
You are entitled to express, and what you expressed is a real, genuine thing. Government should, it's a policy matter. So it's a policy matter at higher level. Government only has to take the decision.
But at least you could have opinion, right?
Yes. We can.
The opinion is favorable or unfavorable, is against the interest.
Double taxation we have to avoid means definitely.
Double taxation on small firms, small companies, and also partnerships should be done away with, so that they pass-through entities rather than taxable entities. That is my opinion. Will you concur to my opinion or any different opinion?
So partly I concur with you, because in the case of
Thank you very much.
Please, sir.
Sir, Gangadhar garu, is there any doubt or?
Sir. Hello, నేను మాట్లాడుతున్నా వినపడుతుందా సార్?
వినపడుతుంది, మాట్లాడండి, పర్లేదు.
సార్, ఇందాక మాట్లాడుతున్నప్పుడు 194Q కొత్త సెక్షన్ లో ఎయిదర్ ఆఫ్ దిస్ త్రీ అన్నారు సారు. కానీ ఆ సెక్షన్ చదివితే క్లియర్ గా దాంట్లో ద సెక్షన్ ఈజ్ నాట్ అప్లికబుల్. దాంట్లో ఏమన్నారంటే ఈవెన్ 206C1H అప్లికబుల్ ఉన్నా కూడా 194Q అప్లికబుల్ అవుతుంది అంటున్నారు. అంటే బోత్ TDS TCS అప్లికబుల్ అవుతాయి అన్నట్టు కనబడుతుంది 194Q లో.
అది కరెక్ట్ కాదు సార్, ఏదో ఒక సెక్షన్ అప్లై అవుతుంది సార్.
కాదు సార్, 194Q కింద ప్రొవిజన్ చూడండి. అవునండి, అదర్ దాన్ 206C అని అన్నాడు సార్.
సో డిఫికల్టీ ఇంటెన్షన్ ఆఫ్ మెమరాండం లో మీరు ప్రపోజల్ కాకుండా మెమరాండం కూడా చూడండి. ఇదే సెక్షన్ మీరు మెమరాండం ఎలాబరేట్ గా ఇచ్చారు.
అదే సార్,
మెమరాండం మీరు పూర్తిగా చదివినట్టయితే సో ఓన్లీ ఒకటే రెండు రాదు అనే సంగతి క్లారిటీ ఇచ్చారు మెమరాండం.
ఓకే సార్, రైట్.
Difficulties will be removed at the final stage. Intention of the one transaction, one either TDS or TCS. అంతే, డబుల్ రెండు అప్లై అయ్యే ప్రొవిజన్ లేదు.
అంటే అది బయ్యర్ కి ఇది సెల్లర్ కదా సార్?
బయ్యర్ కి సెల్లర్ కైనా ట్రాన్సాక్షన్ ఒకటే కదా.
ఒకటే, అదే అంటే ఇద్దరిని కార్నర్ చేయాలన్నా ఉద్దేశం అని అది అర్థం కావట్లేదు సార్. అది
0.1% పెట్టారంటేనే దాని ఉద్దేశం ఏంటి? టు ట్రాక్ ది ట్రాన్సాక్షన్ బట్ నాట్ టు మేక్ దెమ్ సఫర్. టు ట్రాక్ ది ట్రాన్సాక్షన్ కదా, 0.1% పెట్టాల్సి ఇక్కడే ఉంది. దానివల్ల
అదే
ట్రాన్సాక్షన్ ట్రాక్ చేసి ఆ 26 రావాలనేది ఉద్దేశం తప్ప
అదే సార్
దాని ఉద్దేశం కాదు.
ఓకే సార్, ఓకే.
ట్రాన్సాక్షన్ ఒకసారి కనపడితే చాలు, కానీ ఒక ట్రాన్సాక్షన్ రెండు సార్లు కనపడటం లేదుగా.
అదే సార్.
So,
okay sir, thank you sir, thank you.
No other further queries, we can conclude the session. Okay, thank you sir, thank you very much for the excellent presentation. As far as the southern region is concerned, you are considered as a Nani Palkiwala of the southern region, definitely. Thank you from the bottom of our heart for coming here, gracing here, and enlightening us on the budget proposals. Definitely it is praiseworthy. Thank you very much. And I request sir, we can conclude the session right now. Thank you one and all.
Thank you sir. Thank you.